by the time we put up the presentation. A very good afternoon to all esteemed members of the press joining here and joining virtually, my colleagues and as well the book running lead managers. I take you past the management presentation on the upcoming public issue, which is, as we called it, is opening on 9th of September for subscription. These are statutory disclaimers. I'll try to run a bit faster because but what are we as company, Bajaj Housing Finance, where is the market opportunity, then what are our relative strengths in this market, and what has been the performance, what we have delivered till date. This is where we are as a group. 90 years plus heritage of the Bajaj Group at a total level, as the group in the country. Bajaj Finserv, financial services holding company of the group. Bajaj Finance is the lending arm, which is a subsidiary of Bajaj Finserv, and we as Bajaj Housing Finance as a 100% subsidiary of Bajaj Finance, which is a lending arm. Other companies in the financial services, whether a life insurance or a general insurance, or a health company or platform companies, and an AMC which has been recently started, are unlisted. So this is going to be third listed company post the issue within the financial services space for the group. Moving on, within Bajaj Finserv ecosystem, in the financial services space, there are three broad verticals, which is one is assurance, which is represented by general insurance, Bajaj Allianz General Insurance, Bajaj Allianz Life Insurance, and Bajaj Finserv Health. Wealth, which is represented by asset management company and financial securities company. In lending, Bajaj Finance and Bajaj Housing Finance. Bajaj Housing Finance is differentiated from Bajaj Finance in the way because we are focused purely on secured portfolio. Largest part of our portfolio is a secured portfolio, and are concentrated or focused on the mortgage products as a differentiator. This is what we have achieved. We are the largest non-deposit housing finance company, and of course the second largest post LIC housing as a housing finance company. Within the NBFC upper layer, we are also 8th largest upper layer company from an asset size point of view. We are one of the most diversified housing finance company because we offer full range of a mortgage product, and we are a fully integrated mortgage product suite company. We have a highest possible domestic credit rating, which enables us to raise money at a competitive rates, which acts as a funnel or which acts as a raw material for us. Amongst all large HFCs, we have a lowest GNP and NPA ratios as of 31st March and as of 30th June as well. We are the second most profit-making housing finance company. Return ratios are strong as we display those ratios as we go. We believe we have the experienced management team to guide the company through. This is where we stand. The growth for last 5 years, which is represented from FY 20 to 24, we have grown at the rate of 29.3%, and the comparative growth path of other housing finance companies is displayed here. Clearly, we have grown the fastest among the peer group in housing finance sector. This is our full suite of the products, which is all 4 products, which is home loan, loan against property, construction finance, and lease rental discounting, and a bit of others products, which is to meet the aspirations of our own customers. We offer some loans to our customers. I will not spend much time on market opportunity because all of us know the India opportunity or the India story. Retail credit has been growing in the country at a fast pace and estimated to grow at a 13-14% CAGR in next 3 years from various projections. And India also has the world's largest population and a low mortgage to GDP ratio, even compared to comparable countries like South Africa, leave aside countries like USA and UK, which gives us a long space to grow the market in the mortgage space. And it is largely driven by urbanization in the country. Government initiatives, quite favorable initiatives of rate also housing for all has been one of the government priority. Rising income levels, as India is rising, the demand for housing is rising and will continue to rise, and a formalization of a credit along with the favorable demographics, because as more young people come, the aspiration to own a house, and thus there were a drive demand for home loan is expected to keep on increasing. Within housing finance industry or within the mortgage industry where we are, when we look at a home loan, the home loan industry has grown at a CAGR of 12.6% in last 4 years, and by various estimates expected to grow between 13 to 15% CAGR in the coming 3 years, the coming 3 to 4 years. And within all asset classes, it has the lowest GNP and NPAs in the retail side, which is at an industry level, which is the first chart at the industry level, the GNP of housing is 1.1 to 1.2%, favorably comparable to any other asset class in the retail space. Loan against property, which is the second part of the mortgage industry, again a very large industry, growing at a CAGR of 16.5%, estimated again to grow at a 13 to 15% CAGR, and which delivers a better returns within the mortgage eco space. Commercial real estate demand has been very robust because that's again one of the product segments what we cater to through lease rental discounting. Coming to our strengths, this is what we were referring to when we referred saying that most diversified full integrated mortgage product suite company. This is a composition of our AUM compared to AUM mix of other housing finance company players. A pretty well diversified 57.8% of our AUM as of 31st March was represented from home loans, at 10.5% from construction finance and loan against property, 10.5, 19.5% from lease rental discounting, and 1.9% from other assets. When you look at the spread compared to other indices, you will find that this is one of the most diversified spread across all segments of mortgage industry. These are what we call our, what are the traits what we possess to strive to win in the mortgage space, because mortgage space is a competitive space and a fragmented space. We have a comprehensive mortgage product suite covering all segments because we believe presence in all segments and all sub-segments is essential for you to continue to grow at a healthy pace, because at a point of a time there can be times when a particular product segment is not doing well. So if you are present across all segments, you can continue to grow. We have an omni-channel sourcing strategy. I cover a bit about it as we go forward. A very strong risk management framework, which is demonstrated by a very healthy asset quality and a low credit cost over the years. We have access to diversified and cost-effective borrowing sources, which is a raw material for us and gives us an ability to compete. Ease of doing business for customers as well as employees through digital initiative. Digital comes as a GNA from our Bajaj Finserv group orientation. Our leveraging of technology or enablement of a technology to do business, I think is where we excel at. Consistent financial performance, which is backed by business growth, balanced portfolio, and operating efficiency, because given mortgage is a low margin business, operating efficiencies, process efficiencies becomes essential for us to deliver what we intend to deliver. We have a quality board of directors and ably supported by an experienced management team. These are now at the product segmentation level. Home loan, 53,000 crore of a balance sheet, close to 53,000 crore of a balance sheet as of 31st March, operating in 174 locations, a mix of urban and rural locations. Average ticket size of 46 lakhs, dominant portion of customers with bureau above 750 and a dominant portion of a salaried home loan. But we are present across all segments of the market, whether it is a new home purchase, resale, or a balance transfer, and we cover all segments of the market, whether salaried or self-employed. A focus on a particular segment can be higher at a point of a time. Basis the calculations on risk return. Loan against property, close to 9,600 crore of a balance sheet, operating in 74 locations. 58 lakhs kind of a average ticket size. A mix of a self-occupied residential property at a 71%, which is a depiction of a low risk parameter. 17,500 crore of a lease rental discounting balance sheet, which is 19.3%, largely 14 locations, because it's a industry which is in mostly concentrated in metros and the megapolis. Ticket size of 100 crore average, it's a chunkier business. With 237 active customers. Here, while we cover the all spectrum of market, but the domination is more for an office space, which is office grade A commercial built out, leased out to various companies. 9,500 crore of a developer finance balance sheet, again operating in 13 locations. Average sanction ticket size of 44 crore and 616 active projects, which is representing this balance sheet, giving it one of the most granular balance sheet mix out of this business, so that the risk is well diversified and well spread out. That is where our products are there. Omni-channel sourcing strategy, what we talked about first the retail, which is a home loan. Mix of the balance sheet is 56% direct and 44% indirect. We leverage across all direct and indirect, whether it is a direct is also of course a developer counter, where technically where it can be a B2B2C, but at a developer counter where our teams are present to source, or whether through the digital ecosystem or through the digital partner, or self-sourcing by our direct sales teams. And as far as indirect is concerned, all partners from a smallest to the largest distribution partners is where we are present at. Loan against property, a broad mix of a 50-50 between direct and indirect. Again, all sources present. And in enablers at the developer side, we get enabled in the home loan with our funded projects. Construction finance, one of the largest driver is it acts as a funnel. It gives us an access to the customers who are buying homes at that project, and other non-funded projects as well through the APFs or through the teams paving the road. We are present there. Search engine optimization of the digital marketing are the tools for us for leveraging the digital ecosystem. Commercial businesses which are both lease rental discounting and construction finance, they are largely relationship led, while there is some part of a distribution mix incomes, but they are largely relationship, and which is led by relationship teams who have built over a period deep relationship with all the market players in the market. This is where what we call out our strong risk management framework and asset quality. Our underwriting frame is largely organized in underwriting hubs, because we are dispersed in the front end, in the mid and the back office. We are consolidated to give controllership more, so that's underwriting is largely done in the 6 underwriting hubs what we have. There are specific underwriting frameworks for each segment, because there is no one size fits all. There is a segment, there's a different frameworks for a salaried or a self-employed or a upcountry customer versus an urban customer. Collateral assessment again through 8 centralized hubs, which is having dedicated team for other legal and technical verification processes, and a centralized hindsighting team prior to dispersal, which makes sure that there are no controllership lapses. Very strong risk management through tracking of a key indicators, whether a bounce rate or any emerging sign of a weakness, so that we are ahead of the time. A dedicated in-house collection team for debt management. It's not outsourced, it's largely run by our in-house teams to manage the debt. Reflective of when we look at a segment wise as well, while at the company level our GNPs have been 28 bips. When we look at a segment wise as well, home loan, our GNPs was 27 bips and an NNPs of 10 bips as of March 24. Very favorably compared to any other industry player, whether banks, private banks, or at a sector as a whole, whether housing finance companies or public sector banks, which are depicted below. FY24 numbers were not there when we finalized the DRHP for the other competitive players, or the industry numbers were not published. Same way in loan against property, GNPs of 68 bips versus an NPS of 26 bips, again compared very favorably against the industry metrics, whether from the private banks or whether from other comparable players. In the lease rental discounting, we had not any episode of any default till date ever since we started the business. There's an underwriting which is by a specialized team, because retail is different and this is having a high ticket size. The underwriting is by a specialist team. Lesser, collateral and lessee are the key framework or key pillars of how do we underwrite lease rental discounting business. Robustness of a lessor, their business framework, historical rental income and the borrowings. In the developer finance, it's again a specialist team which underwrites, because it's a very nuanced business which requires deep understanding of the market and a deep understanding of financials and the industry, the way it operates. The developer financial health, historical project outcomes and the project approvals become very critical frame here as we take the underwriting decision. Very strong centralized risk management team, close project monitoring of each and every project which we have funded, and in debt management is a relationship-led business. The outcome is lease rental discounting, nil NPS till date. In developer finance, 15 bips of a GNPS and 4 bips of a NNPA in the company. Overall, 27 bips or 28 bips of a GNPS, 10 bips, this 0.3 is rounded off from 0.28. With a provisioning coverage of a 63.7%. Again, comparable credit cost of last year 10 bips. Again, very strongly or favorably comparable to any of the peer groups in the industry, whether on the GNP ratios, NNP ratios, on the credit costs as published in last 3 years. This is the borrowing mix, the liability side. How do we borrow? As of 31st March, 51% of our entire liabilities was coming through the banks, 10% through refinance from National Housing Bank, which is supervisor in our case, 35% through the money markets, which is the bond market, and 4% through commercial paper. Overall, a very well diversified mix of a borrowing, supported by our highest domestic credit rating for the borrowing program in India. And we continue to enhance and keep on widening our funnel by building more relationships with more number of banks to keep on diversifying the sources of funds. ALM, balanced ALMs from a liquidity coverage ratio is always in much more numbers compared to what regulatory min thresholds are there from a point of view of running a conservative liquidity strategy from the treasury point of view. This is what we called as a ease of doing business through digital initiatives, because that is what comes as to us through as a DNA in the group for how do we enable the customer for onboarding in an easier manner, how do we ease the process for our internal stakeholders, which is our employees, as they interact with the customers, how they can be more digitally interactive with the customer without being interfacing with them in the physical space at the branch where they don't have to come too much of a branch. Our 100% cloud-based IT architecture supports that. Our sales teams can source from anywhere and push the case in the queue in the centralized hubs queue, which are running centrally. Sales mobility app from a debt management app for again enabling the debt management teams to be interactive, not to be coming back and being enabled there. Ease of process for the customer, whether it's a customer onboarding journey, DIY, what we call a do-it-yourself home loan journey, sanction letters or agreements to the extent feasible, going through the e-method so that there is less of a wet signatures and more of an instant transparent agreement and the sanction letter copies digitally executed with the customer. Ease and in the operation side, which is internal again from internal stakeholder, various ML based, machine learning based alerts so that controllership lapses are not there from us. And then we take it to the service. How easily you can service a loan of a customer who has been acquired is again the orientation we bring through self-service portal and also the customer service app. We are largely all the requirement what you have of servicing is able, the customer is able to do it himself or herself on the portal or the app. This is what is the outcome of our financial performance. Last 3 years, a CAGR of 31%, Sanjeev called out 50,000 crore in FY22, we were to 91,000 crore as of 31st March and 97,000 crore of course on 30th June. PAT CAGR of 56% over 3 years, 709 crore moving to 1731 crores from FY22 to FY24. Income cost metrics are going down on the favorable side. The cost to income ratios which should be going down is going down, and return ratios are healthy return ratios of a 2.3 to 2.4% ROAs with a 14 to 15% return on equity in last 2 years what we have delivered. This is the board of directors, of course led by Sanjeev as chairman and 4 independent directors. This DRHP 3 independent directors, and fourth independent director, Mr. Swami joined our board post DRHP filing. So 4 independent directors and 3 non-independent directors on the board. Rajiv of course is managing director of Bajaj Finance and the vice chairman for Bajaj Housing Finance. Management team, most of us have experience in the group. That is where we started our careers. There's a right blend of outside talent we sourced, which we brought in to have the industry led, and also the internal group talent to make a team which can execute in line with the group vision, but in the market space where we operate. This is what we call how we will drive our future growth through, because that is on the past. We continue to leverage technology because that's what we call out as our strength, and leverage technology and analytics so that we can continue to enhance productivity, which is process efficiency as well as cost efficiency. We continue to improve customer experience for customers to keep on preferring us against various players. Keep on diversifying the borrowing profile because we want to continue to optimize borrowing costs, because as I called out, it is our essential raw material for our business. The ability to borrow at an optimized cost is the most essential ingredient for us. And we continue to diversify and strengthen our market presence with a strategic customer focus what we have, and continue to focus on the risk management frame the way we have done. This is what I had on the company. Thank you very much for your patient listening. Thank you very much.